Should your not-for-profit apply for a loan? Perhaps you want to buy new equipment or build an extension to an existing facility. Maybe your nonprofit generates revenue unevenly, or you need help to recover from a financial blow. For-profit companies often borrow extensively to grow, but they also generally produce reliable cash flow with which to repay debts. Loans to nonprofits can be riskier for both the lender and the borrower. Before your organization commits to applying for a loan, anticipate lender scrutiny and perform careful due diligence. Cons and pros. The primary drawback to any loan is that you must pay it back. And of course, you'll have to pay interest. Rates for nonprofit loans tend to be higher than those for businesses because nonprofits often pose greater risk. Also, other expenses associated with loans, for example, appraisal charges, closing costs, and attorney's fees, can add up quickly. And your nonprofit may be required to make a significant down payment. However, once you're approved for a loan from a reputable lender, you know you'll get the funds. Also, applying for a loan may require less time and effort than fundraising, wooing major donors, or seeking grants. Loan options. Your funding needs and financial situation will help dictate the type of loan you should apply for. Common options include lines of credit. Does your nonprofit typically experience revenue peaks and dips throughout the year? This can lead to cash flow crunches. In such situations, a revolving line of credit may be suitable. Bridge loans. Sometimes cash flow issues can arise less predictably. A previously reliable funding source might dry up, or a natural disaster could hit when cash reserves are low. In such circumstances, consider a bridge loan, which typically lasts no longer than 1 year. Long-term loans. Standard loans with extended repayment schedules can be an option for major purchases or projects. You may want to finance a project with a capital campaign. However, campaigns can take longer than anticipated. A long-term loan can help you avoid delays while you continue fundraising. Sometimes nonprofits encounter opportunities that require prompt action. For example, office space you've had your eye on suddenly becomes available, or you want to merge with a mission-similar organization. Both bridge loans and long-term loans may prove useful to finance such opportunities. Preparing your application. Once you determine your financing needs, you'll need to apply for the loan. Lenders generally ask about plans for any loan proceeds. They'll require you to provide several years of tax filings and audited financial statements, reports of pledges, receivables, accounts payable, and outstanding debt, a description of major funding sources, and a board resolution approving the loan. You may also need to submit information about your organization's history, including articles of incorporation and bylaws, management and board of directors, short and long-term strategic plans and programs. Lenders often ask for cash flow projections, showing a repayment plan as well. A demanding process. Obtaining a loan can be a long and demanding process, and some nonprofits simply won't qualify. Higher interest rates also mean borrowing can be expensive, particularly if your lender considers your organization a risky bet. Contact us for help applying for loans and to discuss other, potentially more accessible financing options.